In previous lecture, we learned about how AFM basics, that is the time value of money concept, forms the base of AFM, and how NPV concepts are treated. Okay, first watch that video and then come to this video. We'll start with security valuation. Okay, let me tell you that when after finishing a concept, we will do questions of it. Okay, we have roughly 22 questions in this. We have roughly 67 questions in this total chapter. Okay, this chapter is divided into 4 parts. That is the introduction part, the basics, the valuation of equity shares, valuation of bonds, and other topics. Okay, let me tell you that after we finish a concept, we will do questions of it. A question which is tough, I will solve it by hand, and the questions which are easy, we will just go through or audit from Ajay Agarwal's question bank. Okay, Ajay Agarwal's question bank is what we use in this video, and his concept notes is what I'm using for teaching the concepts. You can buy it from his site AIR1CA Career Institute. Okay, let us start. This chapter is divided into 4 parts, as I told you earlier, which the first one is the introduction part, the second one is valuation of equity shares, the third one is valuation of bonds, that is fixed income securities, and fourth one is other topics. So what do you mean by security? First of all, we have learned in 12th standard, if you are from SP background, then you might know there are various types of securities. Securities means which are traded in the market. Okay, which market? Financial market. What do you mean by financial market? A stock exchange, the money market, or capital market. Financial market is a broader term. Stock market comes inside it. Okay, so what we are trying to do in this chapter is we are trying to value the securities. If you want to buy a security from the market, what will be its value? But should we invest in those security or not? Okay, if we are investing in it, what is its value? What is its actual value? Is this overpriced or underpriced? This logic will flow throughout the chapter. Okay, so let's start. We have given a simple meaning here that it involves valuation of prices of securities so that the investor can take decision regarding purchase of sale of securities, as I explained you earlier. We use fundamental analysis approach. Okay, this one you have to know. Okay, there are 2 types of analysis for security analysis, that is technical analysis and fundamental analysis. Technical analysis, we'll do it in different chapter, that is security analysis. It's a small chapter. Our AFM focuses mainly on fundamental approach. Okay, what is fundamental approach? It is using financial data of the company. So we have another basic. We have passed CA Inter, right? In FM, we used to have a concept called CAPM. You might know that concept. You might have just rectified the formula, and you might know the formula. What is its formula? The required rate of return is equal to, that is KE. You might remember, right? KE is equal to RF plus beta RM minus RF. This formula we all know. Okay, this formula derivation will be learning in next chapter, that is portfolio valuation. we'll learn it in portfolio chapter. As of now, we just need the basics of it, like how we used to do it. Just brush up the topic. Okay. KA is our required rate. RF. RF is, I'm just quoting the concepts here, the denotions here. I'll explain it later. Okay. RF is risk-free securities. Beta is beta of security. I'll tell you what is beta also. Okay. RM minus RF. It is our market risk premium. RM is risk of market. And RF is our risk-free securities. Mind it that the risk of market and market risk premium both are different terms, and it becomes very important to understand this. Okay, this RM minus RF is market risk premium. Okay, when we invest in market, what is the risk premium am I getting? So inherently, market market, the return of market is more than the risk of the risk-free securities. Okay, always keep this in mind. Always keep this in mind that the risk of market is more than the risk-free securities. This formula denotes that how much market risk premium am I getting from investing in the securities. This beta means risk. Beta means risk. How much risk am I taking in the market from investing in this market? Okay, beta of security. Why is it of just security? Beta risk of every security is different. If you take it practically, when you see in the market, okay, we have various shares: Reliance, Tata, Adani. Okay, does shares of every company move in the same direction? No, right? Does every company move in the same percentage? No. When Adani moves, let's say 5%, Tata might move 7%. So what does this mean? That they are moving with the market. The market is uptrend. Okay, they are moving with the market, but in different ways. Okay, so they have different risk component. When Adani share fall by 10%, Tata share may fall by 5%. Okay, so when market goes up, it's going on different rate. When market comes down, it comes on different rate. So there is different risk factor for everything. Okay, so that is denoted by beta of security. Here he has written the same. Okay, RS, that is required rate on required rate of return on security, risk free security plus risk premium on security. Okay, how much risk are we bearing since we are investing in the market? Now we'll move on to the main part of the chapter. This part is important for the exam. Okay, questions do come from this, so we'll try to finish off this part today. In this part we have 22 questions, and I'll just solve the tough questions here by hand, and the easier ones I'm skipping. The basic, just formula driven, I'm just skipping. Okay, that you can practice on your own. The tough sums I'm doing it here, you can just refer it. Okay, the concepts I'll be explaining it fully. So let's start. The models of valuation of equity share, we have two models. Okay, One is dividend based model and another one is earnings based model. Why are these two models given? Okay, so in dividend based model, we have in inter we had learnt some theories, okay, that Gordon theory, Walter theory. We'll primarily focus here on Gordon's based model. Okay, what does Gordon say? So he was a financial dikkach. Okay, he was a great financial personality. What did he give to the society? What is his assumption? Okay, he says that people invest in securities based on dividend. Okay, and they is assuming that people only invest in securities for dividend. Dividend is their primary cash flow. Okay, dividend influences the price of the security. This is this main preconceived notion. Okay, and dividend influences the price of the security. This you have to keep in mind. Okay, so what is this assumption? Is that perpetual dividend, that the company will pay perpetual dividend with constant growth. Okay, like let's say 5% will be growing constantly. If 1 year he is getting 2 rupees, the next year he'll get 2.1, and the next year he'll get plus 5%, and so on and so forth. That is his assumption. Okay, so as I showed you in the last previous lecture, that the formula, how is this derived? This is our income. Okay, this is my required rate of return, and this is growth. I told you in earlier lecture that whenever there is a growth factor in the question, there is a growth factor, we will reduce our required rate of return, right? The required rate of return gets reduced, his expectation becomes less. Okay, because every year it will go on adding 2%, then this will become wrong, right? If you just keep it, his expectation is 10%, then it will become 12%. So we have to reduce it to keep it to 8%. If we keep this his return as 8%, then the growth plus 2% will automatically give him 10%. I'm taking the example we discussed in last year. Okay, if you don't understand this formula, you can just mug it up. Okay, what is V0? V0 is the intrinsic value of the share. That is the value we are giving to the share. That is the, earlier we used to write this in inter as P0. Okay, here we are just giving it as B0. We are just quoting it differently. It is known as intrinsic value. Also, it is also known as equilibrium value, fair value, theoretical price of share. If anything comes in exam, we have to write this only. Just mind the names. Okay, equilibrium, fair, theoretical price. What is D1? D1 is the expected dividend for per share. That is the dividend which will be received in the next year. And D0, it is just paid. He hasn't given here how it is derived. Okay, we can write this also as D0 into 1 plus G. We'll add the growth factor KE minus G. Okay, G is growth rate, and this one is important. Okay, we have learnt in inter also, retention ratio into ROE. Why is this one given here? Okay, retention, what do you mean by retention? When in the income statement, we arrive at EBIT, right? We arrive at EBIT, then we deduct interest, then it comes EBT, then we deduct tax, then comes EAT or PAT, then we give share or preference shares a dividend, we get equity earnings available to equity shareholders, then we divide it in the number of shares. Okay, we get EPS, and then we'll get a certain amount of ratio that is known as DPS, dividend per share, and the rest is retained. Okay, the one which is retained with us, the one which is left with us, it is known as retained earnings after distributing dividend. So this growth factor, when you check it, retention ratio, what is growth? When the company retains the amount, they won't keep it in bank, right? They will invest it somewhere. They will invest it in their business for their business to grow. Okay, so what will we do to decide this growth factor? We will multiply with the return on equity. Okay, how much return these equity holders are getting, that we will multiply it with retention ratio, so we can get the growth factor. Okay, what is return on equity? In Inter, you might have seen this as G is equal to B dot R, that is B into R. B is your retention ratio and R is your return on equity. You remember it, right? If you don't, I'm here to teach you. Okay, what is return on equity? There are many ratios given in Ajay Agarwal's book. We'll just brush it up when the need arises. Okay, what is return on equity? That is equity earnings available to equity shareholders divided by book value or net worth. What do you mean by book value? It is net worth. What is net worth? Net worth is your share capital plus reserves and surplus. Okay, share capital here only denotes equity shareholders. Anyways, in most of the companies, 95% of the companies just have equity shares and not preference shares. Okay, so how else we can derive it? Total assets minus total liabilities. What is total assets? Fixed asset plus current asset minus your current liabilities. You will get your current liabilities and debt. Okay, total liabilities means current liabilities plus debt. You have to minus it, then you will get net worth. Okay, so what is return on equity? Return on equity is earnings available to equity shares divided by, this is on total base. Okay, how much each one of us is getting. If you want to take it in per value share, then we'll do it as EPS divided by book value per share. What is book value per share? Book value divided by number of equity shares. What is book value? Net worth. Okay, this ratio will also be useful. We'll be discussing it later. Okay, let me tell it to you now only. P ratio is price upon earning. Okay, price is MPS, market price, earnings is EPS. Okay, sometimes we do calculate ROE in market price. Okay, so how do we denote it? Instead of BVPS, we just take MPS. Okay, EPS upon MPS is return on equity. Okay, if we have to take it in market price, we'll just substitute BVPS with MPS. Hence, this ratio arrives. P ratio is equal to 1 upon ROE. This is very important. We'll use it in one of the sums. Market cap is MPS into number of equity shares. Okay, this is basic. Or this one, this is important. P ratio into, if P ratio is 8 or 10, we'll multiply with earnings available to equity shareholders. Okay, it also gives us market capitalization. He has given an example here. We have D0 as 10, growth 5%, KE 15%. How we put it? What is the value of the share? What is the intrinsic value, equilibrium value, fair value, theoretical value? We'll do it like this. 10 into, it will grow, okay, 1.05, and KE, that is required rate of return 15%. Since it is growing every year, our required return will be deducted by it. Okay, so that it is equal. It is growing, so it is growing on one side, and the return we want a return of 15%. Since it's growing every year, we don't need 15%, we just need 10% plus 5%. Okay, so it will be set off. So we'll deduct it from the required return. And we get the answer as 105. Perpetual dividend with variable growth assumption. First we had constant growth, now we have variable growth. Variable growth means every year there will be different growth rates. First year it will be 5%, second year it will be 3%, okay, and so on. Or else for the first period it will be for 5% for the first period, amount of period, that is first 5 years, and the next 5 years it will be 3% or anything, or 10%. There is 2 stage only. Okay, so this model is also known as 2-stage dividend discount model. Okay, in question you might see this name, 2-stage dividend discount model. So how do we calculate that? As we learned in NPV, that as we learned in that time value of money basics video, we'll do the same here. Okay, first we'll do PV of uneven cash flows, that is uneven dividend. What does Gordon assume here? What is the income they are receiving? That is dividend. Okay, first we'll do PV of discrete values using the table. Okay, this is table. And PV of perpetual dividend, that is PV of terminal value. When it's perpetual, I showed you in the earlier classes, that's the same thing. So we have an example here. D0 as the same example, G5, first 3 years 5%, and thereafter it is 15%. For the first 5 years it is, for the first 3 years it is 10%, and thereafter it is 5%, and we have a KE as required return as 15%. For the first 3 years it is 10%, right? So we'll use this thing. It will grow by 10%. First it is 5 into 1.1, 5, then 5.5 into 1.1, it is growing by 10%, it comes to 6.05, Then 6.05, it is growing by another 10%, and it 6.665. Okay. PV factor of 15. How do we take it? I am telling it you again. 1.15, that is 1 into 1. You understood, right? 1.15 divided by 1, 2, 3. Okay, 658. We'll round it up to 3 decimals only in PV, and we'll multiply it. Okay, and we'll get an answer. Okay, PV of all inflows. PV of perpetual dividend with fixed growth rate from 4th year and onwards. Okay, here in this example, it is growing by 10%, by 5% thereafter, 4th year. What will we do? Terminal value of 3 is equal to D4. D4, what will be D4? 6.55. 6.655 into 1.05. It will grow by 5%, right? It is for the next year. Next year it will be this one. D4 will be D4. And year 4 it will be 6.98 divided by 15 minus 5%. This is a growth rate. This is our K. K minus J. K will remain 15% and growth will be 5%. So 6.988 divided by 10%, it will come to 69.88. Okay, this one is not discounted. Okay, so we have to discount it with the 3rd year's PV factor. Why we do it, I explained it in the last lecture. Okay, 0.658, we get 45.98. Now what is our total value? This is a terminal value. Okay, this is a terminal value. We'll add it with this one. We get it every year, right? This should be my intrinsic value. Okay, share, we have another. We will move on to the next type. Okay, in this type we will see that there is uneven cash flow. Okay, and then we'll sell the security, we'll sell the share. Okay, so what will be our intrinsic value? We'll treat the sold share as terminal value. Okay, this method is also known as two-stage discount model, just a different thing. That is, what if the share is sold after 3 years? Okay, D0 is 14%, G is 9% per annum for the first 3 years, and the price is expected to be received at the sale of share at the end of the 3rd year at 360. Okay, end of the 3rd year. Mind it, end of the 3rd year. And K is 13%. We'll solve it normally, that the dividend, like we discussed in last lecture, last sum. Okay, 14 into 1.09, it is growing, and 15 into 1.09 and 16 into 1.09, we get dividend and PV factor 1.13 divided by 123. Okay, we'll get 3 PV factor and we'll multiply it with the dividend and we get PV and we'll total it. Okay, this is basics. And now this is the important part. Okay, we are receiving it at the end of 3 year. Okay, end of 3rd year, how much is the PV factor? 0.693. Okay, this 360 is not PV'd, it is not PV factored. Okay, we have to know its present value. So how much will it be? Its present value 249. 249 rupees will get. Okay, when we sell the share at 360 rupees 3 years down the line, what will be its current value? It is 249. Okay, right? And how much income will we get in these 3 years? It is 39.0. We'll add it. How much is our intrinsic value? It is 288. We have some notes here. It is very important. Please listen to it carefully. If question is silent regarding whether dividend is D0 or D1, this happens many a times, so listen carefully. Then assume it as D0 in following cases. We have to assume it as D0. Otherwise, we will assume it as D1. Okay. In what cases it will be assumed as D0? The first thing, when it is dividend paid or dividend pays in question. In question, they will give it as dividend paid or dividend pays. Dividend pays is present tense, right? Paid is past tense. Past tense or present tense, we will take it as dividend paid, that is D0. And when in question, dividend is given in income statement. Okay, in the income statement, when they are giving, in the income statement, when they are giving, here it is dividend paid on equity shares. It is already paid. When they are formatting income statement, dividend is already paid. So we'll take it as D0. Okay, this one is also important. Keep it in mind. Decision making based on intrinsic value of share. This V0, what we got, V0, that is intrinsic value, fair value, equilibrium value, theoretical value, whatever name you want to call it. How will we make the decision? Let's say when the intrinsic value, that is the value we are getting here, okay, I'll teach you in this example only. Okay, how much we got? We got 288, right? 288.05. Okay, let's suppose the market value is 300. Okay, the market value is 300, but its intrinsic value, its actual value is just 288. This is bigger. Okay, so should we buy it? No. Why? Because the market price is more. The value of share, the actual value is very less. Okay, but it's overpriced. It is overpriced. If we'll get it equal to 288, anyways we want to invest, right? Anyways we want to invest, it is equal to the market price, so we will invest or buy. It is fairly valued in the market, so we will buy. When intrinsic value is 0.5, okay, 20, but let's say in market it is getting for 250, we will buy. Why? Because in market it is valued very less, but its actual value is 288. So in this case, we will buy the security. Okay, this is what is given here. If intrinsic value is greater than MPS, it is underpriced, so buy share. If intrinsic value is less than current market price, it is overpriced, so sell the share. Sell the share. If intrinsic value is equal to current market price, it is fairly priced, so buy the share. Okay, I showed you an example and you might have understood it. We'll move on to the next topic. Calculation of KE, that is required rate of return using DDM approach, dividend discount model approach. Okay, in case of perpetual dividend with constant growth assumption, we'll do it like this. D1, which is dividend for the next year, divided by P0, that is the current market price plus growth factor. Okay, it will form our required rate of return. This we might have learned in our inter. Okay, the same formula we are going to apply here. Okay, in this example we'll take D1 is equal to 6, P0 is equal to 80, G is equal to 5%. We'll put it in the formula, we'll get an answer. In all other cases, KE is calculated using trial and error method. Okay, what do you mean by trial and error method? In question only they will give two rates. Okay, and in question not two rates, they will give PV factor of two rates. We will assume that no, it is assumed that it will be between those two rates. Okay, we'll have to do IRR. You might have done IRR in your inter. Okay, what is IRR? It is internal rate of return. We'll do it by interpolation method. Okay, interpolation is unitary method. Okay, I'll tell you the formula or the logic behind it. Okay, what will we do it here? We'll just try to understand it here first. We have an example here that company will pay dividend for 3 years. Okay, here 1, 2 and 3 dividend 8, 12 and 8. There is uneven cash flow. Okay, and after that dividend will grow at 10% per annum constantly. Okay, current market price is 200. Calculate KE. We have been given the factors here. Okay, 13% and 14%. Okay, so we'll use this only while doing the table. In the solution, when we calculate, we will calculate with both the rates. Okay, we'll do first dividend, it is common for all. Okay, 10, 12 and 8, and then we'll write PV factor of both. Okay, PV factor of 13%, PV factor of 14%, we'll do PV, and we'll total it. Simple? Yes. Then we'll find the terminal value. We have to find terminal value of both the rates. Okay, using PV. How will we do terminal value? We'll take dividend into the growth factor. Okay, divided by KE. What is my KE here? 13% minus growth rate, which is 10%, into, when we do TV, what we do, we take it to the last known year where the growth was not there, the constant growth was not there, which is the third year. Okay, we'll PV it to that point. Okay, so that we can get a definitive value at our year 0. Okay, or present value. When we do it, what we get? 203. Okay, and when we add it, we get a total intrinsic value of 227. And here we follow the same process. We do 8 is common for all, and we do 1.1, and here our KE becomes different. Okay, it is 14% minus 10% into our third year's PU factor. Okay, mind it, currently you correctly use 0.675. Okay, and not 693. Don't use PU factor of this one. Okay, we'll get an answer both side. Okay, but what is the market price? The question, in this question, we are expected, what is the formula? What is the formula of finding KE? What is the formula of finding KE? KE is equal to D1 upon P0 into 100, okay, whatever, plus G. Or if you want to eliminate this 100, write G in decimals, okay, 0.05. Okay, you can eliminate this one. So we want P0. What P0 we have here? 227. P0 or V0, okay, as you can understand, P0 or V0. So what P0 we have here? 227 and 171. What is the actual value? It is 200, okay. Our rate lies between 200%, okay. See, we have 13% and 14%, right? At 13% we have 227.07. At 14% we have 171.90. Our rate lies somewhere in between, right? So somewhere in between we have 200, right? So 13 and 14% के बीच में we have something. So how do we do it? We'll do it by interpolation, okay. I'll tell you the formula first. Some might know this formula and some might try to rectify it, okay. It is lower rate plus lower rates P0 minus required rate divided by lower rate P0 minus higher rate P0, okay, into higher rate minus lower rate. This is the formula. But how is it derived? We'll just see that the distance between this and this and the distance between this, we'll divide it with this, okay. 227.07 minus 200 divided by 227.07 minus 171.90, okay. This total distance, it is just unitary method, okay. The total distance divided by this distance, understood? So how much will we get if you put it into this, into higher rate minus lower rate? It is 1% and the higher rate 13%. Simple. So we will get answer as this as 0.49 something into 1% and plus 13%. So we'll get 13.49%. That simple it is. And here we have the formula, okay. Formula for interpolation: lower rate plus value at lower rate minus required value at lower rate minus value at higher rate minus lower rate, okay, as I told you. So this is the concept for today. We'll do questions regarding this in the next lecture.